Everybody, it is Friday, March 1st, 2019, and the market had another positive week here. S&P up 0.5%, NASDAQ almost double that. Biotech's breaking out and holding on to their gains up 4%. Let's take a look at the charts and make sense of it. The S&P 500 on Monday did break the previous little recovery high over here at 33 cents, or the old high was 21 cents. Not the old high, but the high right here on this day was 21 cents, and we had 31 cents. I said that it looked like maybe we need to digest a little bit. We have the possibility of a pullback from here, and we did pull back a little bit. We spent the next 4 days kind of drifting lower, but today we gapped up, pulled back hard, and again we have a rising 5-day moving average. I've been cautious the last couple days, thinking that it's likely the market could break back down, but the fact is we continue to see the rising 5-day moving average, and that gives us the not the confidence to buy in here so much, but the ability to say we're not going to short, not with a rising 5-day moving average. Ever since this market rallied back up above that 5-day moving average, we have not seen lower highs and lower lows with a declining 5-day moving average, and there's been no reason to be short yet. Eventually, the market will pull back again. It can't sustain this type of pace, but it's foolish to try to short it. Look at this, look at the last 9 weeks here, 10 weeks, whatever this is. Just an amazing V recovery, and people have been looking for the place to short it all this way up. The fact is, though, the market is telling us it's still in a primary uptrend. We broke a trend line. It doesn't matter. A trend line means the rate of ascent has slowed. Unless we see lower highs and lower lows, and we're going into next week, I think that this, the low from this week at about 277.5, that's going to be your key level. The thing is, if it's to drop down, let's say straight through that on Monday, I certainly wouldn't suggest you short it on that break. Look for a lower risk entry, such as something like this, with a stop above the most recent relevant high. I'm not calling for the market to go down. I'm not calling it as a short. I'm saying if you're looking to get short, just don't do it after it's already expended a lot of energy to the downside. The NASDAQ, same story. We got below that rising 5-day moving average briefly. We broke this uptrend line that I have in here, but the market did not care. The market was looking at it saying, we still have a rising 5-day moving average. We broke down and trapped some shorts, but then from there we've seen the pattern continue with at least these higher lows. Not quite a higher high, but still we have higher lows, saying there's still buyers in here. We're holding above the 200-day moving average, which is flattened out. Maybe this market is just headed straight for new all-time highs. I don't know. I'm not going to bet on that. Instead, I'm going to take each trade based on its own merits, whether it is showing a pattern of higher highs and higher lows, as it is, that is, showing higher highs and higher lows. I'm not going to fight it and try to get short unless it's for a quick intraday trade, which isn't the appropriate time frame for most people. The Russell 2000 came down to the volume-weighted average price from the 12th of February after it broke this one, and you can see buyers were there. So now we're back above the volume-weighted average price from the peak. We're above the 5-day moving average, which is flattened out. The buyers remain in control of the Russell 2000 as well. We've got a rising 20 and 50-day moving average. The fact is, the buyers are still out there. That's what these higher lows mean. It says that we're not waiting for it to pull back to 156 and a quarter. We're going to buy 156 and a half. We're going to buy 157. So the bargain, they start chasing, at least on the bids, and as less supply comes into the market, the buyers that are there are forcing prices back up again. The semiconductors broke below the 5-day moving average. They did not make any pattern of lower highs and lower lows below a declining 5-day moving average. So the buyers are still given the benefit of the doubt here, maybe turning a little bit more neutral. But the semiconductors, again, they came up to the trend line. Is that going to be resistance? You can say it was resistance, and that's fine because we haven't pierced through that on a closing basis yet, but it doesn't give you a good risk reward yet that I can see. So again, wait for the evidence. The biotechs, they broke beyond here. We're looking at a 15-minute time frame. If you're ever wondering what time frame I'm on, just look right up here in this upper left corner. You can see this is 15 minutes, meaning each candle is 15 minutes, and we've got about 15 days. Now for this week, we saw the biotechs gapped up. They went sideways, tried to break out here Wednesday, but Thursday they came back in. And where did the buyers emerge? Right at the bottom edge of where the support has been, and with that rising 5-day moving average. Now the buyers are back in control. 112 is going to be the most critical level for the biotechs to hold. As long as they're above that, the buyers should be given the benefit of the doubt. It doesn't mean you buy after it's up here at 115. Instead, if you're looking to buy, maybe it will do something like this, and then begin to time your purchases at a as the momentum comes back in at that point. Let's go to the daily time frame. This was the bigger level of what has been resistance. We broke above it, pulled back, and now we're holding clearly above it. That's what makes that 112 level so important to hold, and why I'm not going to get a bearish bias on the biotechs while we're still above that. The financials up through that 200-day moving average briefly, and you can point to it and say, see, I told you there's sellers there. But the fact is, on the 15-minute time frame, we still have a rising 5-day moving average. It does not make sense to short this type of strength, and it doesn't make sense in the financial energy. In the energy, I was telling subscribers, look, we're at the 20-day moving average, but maybe we'll see a deeper pullback. So what we did not want to do was short it on this breakdown, because it came down quickly. It made the lower low below the 5-day moving average, but then we were looking for it to rally back up and then break down. It never broke down. We didn't get short. We dodged a bullet, frankly, there with the financials, and maybe they're now headed for their 200-day moving average as well. I'm going to point out something real quick on Amazon. I know a lot of people are excited about it because Apple rather, because it's Apple number one. The volume weighted average price from the earnings I've been mentioning, and we've seen buyers showing up in that area. Well, now I think from a shorter term perspective, you want to look at the volume weighted average price from the last time that was touched. So right in here, and look at where it held this week. Now the question is, where does it have the potential to go before it might encounter some supply? I think you want to keep an eye on this volume weighted average price off of the peak. So I'm just going to turn that red like that, and we'll consult this again in the future. But be aware of about 180. So your risk reward, in other words, I think your opportunity is up to about 180 in this area, but after that it's likely to at least stall out and slow down. I hope it was a good week of trading for you. Have a good weekend.